Hi everyone, I am Karan and welcome to Karan's Gyan. Today I'll be talking about Mr. Warren Buffett's strategy, and using his strategy I would pick out 10 shares from the Indian stock market that have future potential to be multi-baggers. So let us discuss Mr. Warren Buffett's excellent strategy. So his strategy has three golden criterias. The first criteria is that a share or a company must earn a good return on capital. I'll discuss this criteria in detail. Let us talk about the second criteria. So, this second criteria is a criteria which cannot be quantified. The criteria is basically that the company must be run by an able and honest manager. So, you can't quantify and compare managers of different companies based on their honesty or based on their abilities. Moreover, a manager's ability and honesty may change over a period of time, so we can't quantifiably measure this criteria. However, it is an important criteria. Mr. Warren Buffett chose this criteria because he is interacting with a lot of managers and he's a good judge of character. That's why, based on interaction, he is able to judge a manager's ability and honesty. So we can't consider this criteria being a retail investor being a nobody. Alright, talking about third criteria. The third criteria is really important. It says the company must be available at a sensible price. Well, this is also an important criteria because there's no point buying an excellent share at at an expensive price. You should buy it at the fair price, the fair marked price. You shouldn't be buy it at a expensive or a marked up price. Now, discussing 10 stocks that I picked using Mr. Warren Buffett's strategy. The 10 stocks are Marksans Pharma. So I made a mistake here. Marksans Pharma, Navin Flourine, Britannia, JB Chemical, Medicure, Alkyl Amines, Abbott India, Amruntanjan Healthcare, Vaibhav Global, and Paushak. So I have a lot of criteria. This criteria basically satisfies the first golden rule by Mr. Warren Buffett. It says it should earn a good return on capital. So apart from comparing return on capital, I am comparing the revenue growth, the pre-tax profit margin, the price, and what is the debt situation of the company. So I have used ROE here. I have not used return on capital, but pretty much they are correlated. So let us discuss ROE. ROE suggests a good ROE of a company suggests that the company is able to generate good profit without using much capital. For example, if you have put 1,000 rupees in your company and you are earning 1,000 rupees uh, after investing 1,000 rupees, so I can say you have a good return on capital. You are earning maximum profit by investing least amount of money. Very important criteria. So ROE, revenue growth, is basically how much your revenue is growing. Talking about profit margin is what is the margin of profit for you after, which is basically the difference between the revenue and expenses such as finance costs, raw material, etc., etc. So let us have a comparison of all these shares. So talking about Marksans Pharma, ROE excellent, 18%, a good revenue growth of 13%, pre-tax profit margin is also 14%, good but not exceptional. Talking about the price, 48 rupees, a mere price of 48 rupees. This company is totally debt free, very good. Talking about Navin Flourine, this is a chemical based company. Return on equity is 28%, fabulous ROE. Talking about revenue growth is decent, 6%. And talking about profit margin is excellent, 24% profit margin. It's a rare sight you see a profit margin as high as 24%. Talking about price, about 2040 rupees, debt free again. Britannia, well, who hasn't heard Britannia? Britannia doesn't need an introduction, and I feel Britannia is the best share amongst all the shares that I mentioned, and it is most suitable to all types of investors. So talking about Britannia, ROE of 31%, almost second highest ROE in this group of 10 shares. Uh, annual revenue growth about 5% revenue growth, pre-tax profit margin of 16%, again good. The price is little on a higher side. I would say it's going at about 3,750 rupees. Debt is there, debt to equity 17%. Now, basically, why I have used ROE is because so that I can substantially compare return on equity to debt to equity. There's no point using return on capital employed like Mr. Warren Buffett suggested, but return on equity gives us a good correlation between both these factors, both these criterias, as I say. Talking about JB Chemicals, ROE of 18%, not bad. Annual revenue growth of 8%, not bad. And pre-tax profit margin of 20%, good. Debt free, excellent. So it is trading at a price of 780 rupees, if I must say. Polymedicure ROE 22%, good. Annual revenue again 12%, good. Pre-tax profit 18%, good. Debt to equity is 25%, something to consider. It has the highest debt in all these 10 shares. Price is about 470 rupees. Alkyl Amines, again a chemical share. ROE is 37%, return on equity is 37%, which is excellent, highest of the lot. Annual revenue growth 18%, again highest of the lot. It has the highest ROE and highest annual revenue growth, and pretty good pre-tax profit margin, as high as Navin Flourine. So it is at the second place. So number one in ROE, number one in revenue growth, and at second place for pre-tax profit margin. Debt to equity is there 9%. I would be happier if it had zero debt, but 9% is also manageable amount of debt. Price about 3,300 rupees. Talking about Abbott India, well, Abbott India is Abbott India. There is no doubt this share is on the list. If this share wasn't on the list, then Warren Buffett's trading strategy would have been extremely poor. And since Abbott India and shares like Britannia are on this list, so of course Warren Buffett's trading strategy must have been successful. And we can see by his $1 billion Berkshire empire that he is successful in his trading strategy. ROE 24%, annual revenue growth, a decent revenue growth of 11%, a good pre-tax profit margin of 20%, a exceptional price of 16,500 rupees, debt free. Amruntanjan Healthcare 15% ROE, annual revenue growth of 4%, which is bad, I must say, if I compare it to other companies. Profit margin is alright, about 13%. Price about 450 rupees, again debt free. Vaibhav Global ROE 25%, annual revenue growth of 9%. Pre-tax profit margin of 12%. Price is about 1700 rupees, debt free again. Talking about Paushak, so I won't recommend Paushak at all. Paushak has the least amount of ROE, zero annual revenue growth. However, its pre-tax profit margin is 33%, which is the highest of the lot. So just because of pre-tax profit margin, I won't only one criteria is good about Paushak. It is debt free. Even this criteria is good, but Paushak is a small cap company. It has market capitalization of about 1000 crores. So it just came from micro cap to small cap. Again, a thing you need to consider. So talking about, since I talked about return on capital or return on equity, I'll be talking about it should be available at a sensible price. Since I can't quantifiably measure the ability and honesty of managers, I won't even consider this criteria as of now, but it is a very important criteria, as you must know. So talking about third criteria, they must be available at a sensible price. So how do you find if a share is available at a sensible price? I would say, instead of finding the PE, I would say compare it to its peers. Just like how you compare a good student with other good students, similarly compare good shares with other good shares and see how well it is marked. Now, talking about Marksans Pharma, now P ratio, we can see it is 16.62 compared to other pharma companies which have PE of above 30. So we can say Marksans Pharma is valued cheaply. Talking about Navin Flourine again has the least PE with all the other chemical companies. 24 price to earnings ratio, and about price to book value is the second lowest. So again, we can say it is at appropriate price. Britannia Industries, it has the price to earning ratio of 65, which is lower than Hatsun Agro, Nestle, Zydus Wellness. I can't compare Hatsun Agro or Zydus Wellness to Britannia. However, I can compare Nestle to Britannia, and I can say it is cheaply valued compared if I compare both PE and PB ratio. Talking about JB Chemicals and Pharmaceuticals, again PE ratio is lesser than the other pharma companies, Sun Pharma, Dr. Reddy, Cipla, 22 PE compared to high 30s of other companies. Talking about Polymedicure is basically into medical devices. So its price to earning ratio is 40, and Borosil Renewables is basically the market leader in this industry. I would only compare it to Borosil Renewables, and it seems that the P ratio is just mere 40 compared to 2000 of Borosil Renewables. Has anyone seen this high P ratio? If you have seen, please comment. Talking about alkyl amines, again, alkyl amines is cheaply valued compared to Aarti Industries, Unity Organics. However, Navin Flourine is cheaper than alkyl amines. I discussed Navin Flourine earlier. Yeah. So I would say if I compare Navin Flourine to alkyl chemicals, I'll just give you a bonus analysis. So we can see though Navin Flourine has lower valuation mainly because of lower ROE and lower annual revenue growth, but the pre-profit margin is equivalent. However, Navin Flourine is debt-free and Alkyl Amines is not. So again, Alkyl Amines, I feel it is fairly valued. Looking at the numbers, Abbott India is highly valued, has highest P and highest price to book value if I compare to other pharma. Talking about Amruntanjan Healthcare is again in pharma industry and it is highly valued, just like about India. Talking about Vaibhav Global, so Vaibhav Global is in the field of apparels, clothes, accessories. It is cheaper than Page Industries, VIP Industries, and at par with Lux Industries. Also, the PB ratio is also one of the lowest, so again, a good price. So, guys, this is my analysis on 10 shares. I have compared the return on capital metrics and the sensibility of price for 10 shares based on Mr. Warren Buffett's strategy. And I hope you like my video. So, thank you very much and have a nice day.